from that standpoint. Interest rates. You know, you've often talked how important that 10-year interest rate level is. And when I look at financial markets over a long period of times, I can sometimes identify when that individual had come into financial markets by what period of time and the interest rates. So in the 1970s particularly, the volatility of financial markets, you saw over the next decade, many of the people that were CFOs became CEOs because how you financed your company allowed it to exist. In the last few years, we've lost 3 as independent companies, major financial institutions, due to the fact that they had bought $250 billion of U.S. government intermediate securities and borrowed overnight. So when you look at interest rates and the 10-year, and as I mentioned to you, I got this app on my phone that anytime the U.S. government's prices change by more than 2% in 2 hours, off my phone goes. So in the 1950s...
Please don't share that with the president. Please don't.
So in the 1950s, if you were trading governments, it was like watching paint dry. You could see an entire variation of maybe 2% in price in an entire decade. We now have seen a variation of more than 2% occur in more than one day. How do you see the importance of the level of interest rates in our economy and what you want to achieve?
I think that I'm not going to talk about the Fed. I've said I won't talk about their future mistakes. I'll only talk about their past mistakes. So I thought it was important to focus on the 10-year, and the 10-year has a lot of things wrapped in it. It's the short-term rates, it's the term premium, and we're focused on creating the best environment for stable rates. And I think a lot of what we saw in April was this periodic unwinding that I've experienced, you've experienced, most people in this room have experienced in their career. I'm a big believer in the Hyman-Minsky, stability leads to instability. So I think we probably had a very stable period. A lot of leveraged players built up very large positions. There was an uncertainty shock. They're out. But what we're trying to do is to go back to the Trump 1.0 non-inflationary growth. So I think if we can put non-inflationary growth in place and take away, back to your initial question, why am I sitting here, is to take away the credit risk of the U.S. government, then I think rates will naturally come down. And as I've said before, there's an opportunity here that if we can do it, the goal on one side, I call it reprivatizing the government, or reprivatizing the U.S. economy. On one side, we want to bring down government borrowing slowly, maybe decrease the deficit by 1% a year. So by the time President Trump leaves office, we're back at the long-term average of about 3.5% deficit to GDP, and the denominator grows faster than the numerator. Debt to GDP goes down. So we're decreasing the government in the economy. At the same time, we are right-sizing government spending and government employment. And then on the other side, through financial deregulation, we're releveraging the private sector, and then the excess employment that was shed in the government economy can go to the private sector. One thing, I've never lived